Your council tax bill could double overnight, but here's the shocking truth. 80% of the £4 billion tax grab will come from middle-class families, not the super rich. And G homeowners facing £4,000 annual increases, property values crashing 20%. 2%. This is the UK's biggest stealth tax in decades, and it's hitting the wrong people. Welcome back. If you own a home worth over £750,000 in the UK, or if you're already struggling with rising council tax bills, I need your complete attention for the next 10 minutes. Because the UK government is preparing what could be the most controversial property tax increase in modern history. Chancellor Rachel Reeves is reportedly planning to raise £4 billion by doubling council tax on Band G and Band H properties. Sounds like it's targeting millionaires and mansions, right? Wrong. The shocking reality is that 80% of this money, over £3 billion, will come from Band G households. These aren't oligarchs in mega mansions. They're teachers, nurses, police officers, and retirees living in ordinary family homes that happen to be in expensive areas. Today, we're exposing exactly who this tax really hits, why it's profoundly unfair, what it means for property values, and what alternatives exist. Whether you're a homeowner, renter, or just trying to understand the UK's broken tax system, this affects you. Let's break down the numbers that the government doesn't want you to see, the shocking reality who really pays. Let me hit you with the facts immediately because they're jaw-dropping. The Financial Times reported that Rachel Reeves plans a budget tax rate on expensive homes expected to raise around £4 billion. The plan? Double council tax for Band G and Band H properties. But here's what nobody's telling you. Less than 20% of that revenue comes from Band H, the actual mansion's worth over £5 million. Roughly 80% comes from Band G homes, valued between £750,000 and £5 million. Why? Simple math. There are approximately 888,000 Band G properties in England, but only 154,000 Band H properties. That's nearly 6 times as many Band G homes. So even though Band H sounds like where the real wealth is, the bulk of the money comes from the much larger group below them. What does this mean practically? If you own a Band G property, your council tax will jump from around £3,650 per year to over £7,300. That's a £3,640 annual increase, more than £300 extra every single month, forever. For a Band H property, the increase is similar in cash terms, about £4,600 more per year. But here's the critical difference. Someone in a £750,000 Band G home pays exactly the same as someone in a £4 million Band G home. Meanwhile, someone in a £749,000 Band F home. This creates an absurd cliff edge. Two identical houses on the same street, one valued at £749,000, one at £751,000 back in 1991, could now face wildly different tax bills. The £751,000 house doubles its council tax. Nothing changes. The middle-class squeeze who lives in Band G Let's talk about who actually lives in these Band G properties, because the reality is very different from the mansion tax narrative. Band G represents roughly the top 3.5% most valuable homes in the UK. Band H is the top 0.6%. So, yes, Band G owners are relatively well off, but they're absolutely not the super wealthy. Research shows people living in Band G properties typically earn £100,000 or more annually. Sounds like a lot? Consider this. After tax, that's £67,000 take home pay.
Yeah.
If it's a dual income household, maybe each person earns £50,000. These are professionals, senior teachers, experienced nurses, mid-level managers, police inspectors, small business owners. A £4,000 annual tax increase represents 6% of their after-tax income. That's significant. That's the equivalent of losing a month's salary every year, just to live in the same house they already own. And here's another reality check. Band G doesn't mean you're living in luxury. In London and the Southeast, Band G can be a modest two-bedroom flat with no garden. I've seen comments from people in Band G properties in Zone 1 London small flats, no lift on main roads. Not exactly palatial living. Outside London, Band G includes ordinary family homes in decent areas, a four-bedroom house in a nice suburb. Nothing extravagant. Nothing extravagant. Just a comfortable family home that happened to cross an arbitrary threshold set in 1991. The real pain hits retirees. Imagine you worked your entire life, bought a family home decades ago when it was affordable, raised your kids there, and now you're retired on a fixed pension. Your house is now worth £900,000 because property prices exploded, but your income hasn't. Suddenly, you face a £4,000 annual tax bill. What do you do? Sell the home you've lived in for 30 years and move somewhere cheaper? This is why critics call this policy deeply unfair. It's not targeting the super rich. It's hammering the upper middle class and asset-rich, income-poor retirees. The property value crash coming now. Let's talk about what happens to Band G property values when this tax hits. Because the economic consequences are severe. The economic consequences are severe. When you increase the annual running cost of an asset, buyers pay less for that asset. This is called capitalization. If a house suddenly costs £4,000 more per year to own, prospective buyers will reduce their offer price to account for that ongoing expense. Tax policy experts estimate this could cause a 20% or more one-off fall in high-end property values, particularly for Band G properties at the lower end of the range. Let's work through an example. You own a Band G house currently worth £850,000. Your annual council tax is £3,650. If council tax doubles to £7,300, a buyer looking at your property will think, I'm going to pay an extra £4,000 every year I own this house. Over 10 years, that's £40,000. Over 20 years, £80,000. Over 20 years, £80,000 future liability from what they're willing to pay today. Using standard net present value calculations, a £4,000 annual perpetual cost reduces the property value by potentially £100,000 to £150,000. So you pay twice. Second, when you sell, you get significantly less money because buyers factor in the tax burden. This creates a horrible trap for current Band G owners, particularly those with mortgages. If your mortgage to the hilt and property values drop 15–20%, you could find yourself in negative equity owing more on your mortgage than your house is worth. And here's the broader market impact. If Band G values crash, that affects the entire housing ladder below it. And Band F buyers won't pay as much because Band G prices have fallen. Band E prices adjust accordingly. The whole market gets disrupted. Plus, stamp duty revenues will collapse. Properties worth over £1 million generate 52% of all UK stamp duty revenue, despite representing only 4% of transactions. If high-value property prices fall 20%, that's potentially £2 billion less in annual stamp duty revenue, half of what the council tax increase was supposed to raise. Why not tax Band H more? The math doesn't work, so the obvious question. Why not just tax Band H more heavily and leave Band G alone? Seems fair, right? Tax policy analysts have modeled this extensively, and the answer is frustrating. The numbers simply don't work. There are only 154,000 Band H properties. Even if you multiply their council tax by 5 or 10 times, you can't raise £4 billion. To get anywhere close, you'd need to charge Band H properties £20,000 to £40,000 annually. At that level, you're effectively confiscating property value. What about adding new bands above H like hone for £1, 5 ahem for £1, 5 am, £3, 5 pounds, and so on? Better in principle, but still doesn't raise enough money without unrealistically high rates. To match the £4 billion from doubling Band G and H, you'd need to apply multipliers of 5x to 10x on the upper bands. That means a £25,000 plus annual council tax bill for a £2 million house. Nobody can seriously propose that without destroying the luxury property market entirely. What about a mansion tax, a percentage of property value, instead of fixed bands? For example, 1% annually on all property value above £1, 5 million. This is fairer conceptually because it's proportional to actual wealth. But to raise £4 billion, you'd need rates approaching 2% to 2.5% on property value. On a £5 million property, that's £50,000 to £100,000 per year. And to Veer. Again, this would cause property values to crash 20%, plus, as buyers capitalize the tax cost. Plus, implementing a percentage tax requires accurate property valuations for 150,000 plus homes. The current council tax banding system was specifically designed to avoid the complexity and cost of detailed valuations. Creating a new valuation system takes years and significant resources. So you can see the government's dilemma. They need £4 billion quickly. Doubling Band G and H is the simplest way to get it, even though it's profoundly unfair. It's the path of least resistance, not the path of fairness. Season A. The regional unfairness. Here's another layer of unfairness. This policy hits different regions completely differently. London and the Southeast have most of the UK's Band G and H properties. In many northern regions, there are entire local authorities with 0 Band H properties. Back in 1991, Almost no homes in those areas were worth £320,000 or more. But Band G exists everywhere. It's the top normal band across most of the country. What does this mean? Oh, what does this mean? It means the tax burden falls overwhelmingly on London and the Southeast, particularly on middle-class professionals living in expensive areas, not by choice, but because that's where the jobs are. The jobs are. Meanwhile, someone living in a mansion on 30 acres in a rural area might be in Band H, but so is someone in a modest 4-bedroom house in an expensive London suburb. They pay the same council tax, despite vastly different actual wealth. And remember, council tax is paid by occupiers, not just owners. If you rent a Band G property, you're liable for the council tax. In the short term, renters bear the full cost of any increase. In the long term, economic theory says landlords bear the cost through reduced rents, but tell that to tenants facing immediate £4,000 annual increases. There's also the second home premium issue. Currently, second homes pay double council tax in England, triple in Wales. If Band G council tax doubles, and you own a second home in Band G, you're now paying 6 times the original amount, a 600% increase. That's essentially confiscatory taxation that would devastate regional property markets dependent on second home owners. Better alternatives exist, so what should be done instead? Because there are fairer ways to raise revenue from wealth. First, comprehensive property tax reform. The council tax system is based on 1991 property valuations. That's 35 years ago. Most people working in property valuation today weren't even born in 1991. The system is absurdly outdated. A complete revaluation and rebanding, with more bands at the top end, would be much fairer. Instead of just 8 bands, create 12 or 15 bands, with finer gradations. Tax the £5 million properties differently from the £1 5 million properties. Second, reform capital gains tax. Currently, gains on your primary residence are entirely exempt from CGT. This unlimited exemption primarily benefits the wealthy and incentivizes overinvestment in housing rather than productive assets. You could cap the CGT exemption, say, the first £500,000 of gains are exempt. Anything above that is taxed. This would raise significant revenue from genuinely wealthy people making large property profits while protecting ordinary families. Third, make inheritance tax more effective. The government recently announced changes to agricultural property relief and business property relief, but these changes have loopholes that wealthy families will exploit. Closing those loopholes properly could raise billions. Fourth, and this is the gold standard, move toward land value taxation. Tax the unimproved value of land, not buildings. This encourages efficient land use, is harder to avoid, and doesn't penalize people for improving their properties. It's economically efficient and fair. But all of these reforms take time, political courage, and sophisticated implementation. Doubling Band G council tax takes one line in a budget. That's why governments reach for easy options rather than fair ones.